Hello, I'm Virgile Perret from the Observatoire de la Finance, and I'm glad to welcome you to our Ethics and Trust Alumni webinar on digital currencies. To discuss this, I'm pleased to welcome Tara Annison, who is a delivery management lead at Elliptic, and Monika Swaczyna-Pruchnik, member of the Polish Academy of Sciences. Both Tara and Monika are alumni of the Global Prize Ethics and Trust in Finance for a Sustainable Future, which has been initiated and is managed by the Observatoire de la Finance based in Geneva. So before we start the conversation, I would like to recall a few recent facts about digital currencies. First, as you all remember, Bitcoin recently went through one of the largest crashes since its inception. The cryptocurrency has lost roughly half its value since it hit an all-time record in April. And Bitcoin has partially recovered since then, but the damage done is still very significant. Also, China has decided to severely restrict trading and mining of cryptocurrencies. And at the same time, governments around the world are making progress on the regulation of crypto assets, while central banks are also developing their own digital money, so-called central bank digital currencies, including the European Central Bank, who published a report on the creation of a digital euro. So we can see there's a clear competition between private initiatives in digital payments and public authorities trying to regain control over payments. And this trend raises some questions that I would like to submit to Tara and Monika. So first, maybe I will start with a question to Tara. Why did the recent crash on crypto market happen, and what does this mean for the reliability of decentralized cryptocurrencies into the future?
You've already touched on a couple of factors that definitely have had an impact on the price. So the first being the move from China to ban mining activity within the country. There's been a couple of very notable provinces, so Xinjiang, Xinjiang, Inner Mongolia, and Yuan, all of which are very big in the mining space. I think Xinjiang has the most mining out of the whole of China. And what we've seen is obviously a very aggressive move by China to give a director to all of the miners in those areas to move out. So we've seen that mining hash rate, which is the power behind the Bitcoin network, has moved from being based in China to starting to migrate to other locations. So we've seen, for instance, in the US, one of the mining pools there has seen a 15% increase. So kind of across the industry, the hash rate is down about 50%, but we are seeing rebalances. And of course, as people move out from China and get set up in other areas, we should see the hash rate start to increase a little bit more. So a bit of a temporary dip, but that definitely has had an impact on the price. I think in terms of what this means for decentralized currencies in the future, actually it's kind of good news, because what we're watching is a real-time relocation of a very significant portion of the hash rate move around the world. There's no central intermediary controlling this or managing it. And whilst, as I say, there is a decrease in the hash rate at the moment, the Bitcoin protocol is set up to algorithmically adjust to this. So we're watching in real time the whole network basically react to a really big global event. And so far, there hasn't been any kind of security issues or any performance issues on the Bitcoin network. So I think that is actually, whilst very disruptive elements be happening, it's largely positive in terms of decentralization. But that's very much one of kind of, I'd say, three key factors at the moment. So the second is really the fact that the industry has just kind of run out a bit of steam in terms of this bull run. So we've had 4 markets before. They've lasted anywhere from, I think it's about 300 days to like 1,500 days. And at the end of the day, the Bitcoin price can't just keep going up forever. This is not financial advice, obviously, but we have to have periods of adjustment. We have to have periods where the price does decrease. And we've had in Bitcoin's price history, many markets where we've seen huge drops and huge volatility. So actually, I would say that seeing this market crash, as we're calling it, it's kind of normal in the Bitcoin world. We do go through these periods of adjustment. And then finally, I think one of the other factors is, sadly and quite frustratingly, Elon Musk's his tweets. That has had a really big impact on the Bitcoin price as well as the industry. He's raised some valid concerns about the environmental impact, but I must say there is a huge amount of misreporting and kind of low quality research in the area about the environmental impact of crypto. And I could talk about this for hours, but I won't. So I think it's just fair to say that what we will hopefully see is people like Elon's tweets having less of an impact on the price in the future, because there's a decentralized asset, so we shouldn't really be allowing ourselves to have one person with such a big impact. Or if they do, obviously the regulators should be having their eyes on whether that counts as, for instance, market manipulation.
Okay, thank you very much for these insights on China and also on Elon Musk's tweets. It's true that these two elements had a strong impact. So thank you very much. Maybe a question to Monika. In reaction to what happened, but also in reaction to previous crashes with crypto assets, a number of central banks around the world consider launching their own digital currency within the next 4 to 5 years. For example, in the European Union, I mean the Eurozone, we are now talking about a digital euro. So do you think that CBDCs, central bank digital currencies, will make cryptocurrencies and stablecoins redundant in the future, or do you think that they will all coexist in the future payment landscape? What would be your assessment?
So first of all, hello everyone, and I really liked the introduction. I really liked the introduction to the Bitcoin world. Maybe just as an introduction, I hope that Elon Musk would not start tweeting about CBDCs, because who knows what would happen then. So I hope he will steer out of this for the time being. Maybe just an introduction, because I'm not really sure if people who are listening to this, if you understand exactly what CBDCs are and what is the difference to the cryptocurrencies, because there are multiple, sometimes there are mixes and people tend to mix too. And maybe as a beginning, CBDC is not a cryptocurrency. It's a digital currency that's supposed to be a legal tender. So it's a fiat currency that would be backed by some kind of a central bank supervisory authority or government entity in particular state. And it does not necessarily have to use DLT. It probably will in many instances, but it's not a prerequisite. So it is not a cryptocurrency. It's a response to the development of the cryptocurrencies that comes from the central banks and from the central governments, but it's not necessarily similar or not necessarily the same. As you mentioned, according to Bank for International Settlements, around 60% of central banks are in one way or another involved into works or projects or pilot phases already of some type of CBDCs. The pioneers in this area were Sweden with Swedish the e-krona, the very detailed involvement at the earlier stage was in the UK with the British pound. Obviously, right now we've got the digital euro in Europe and some projects with Japan, and obviously there is China, who's already probably the most advanced and already in a testing phase of its digital form of payment. But there are many. Due to the differences between cryptocurrencies and CBDCs, they are a little bit different challenges, there are different benefits, and there are different ways how they can be approached. First of all, the CBDCs are supposed to be state governed. They should be based on a government identification of people who are participating in the exchange of it, who are holding this. some kind of an, it might be using a decentralized ledger. However, it's always some form of government that is involved. And ultimately, it needs to be a mean to manage the monetary policy, financial inclusion in this particular state, and to the greatest extent, free and immediate and fast way of payment for companies and for natural persons. On the other hand, Bitcoin or any other cryptocurrency is right now, contrary to what it was supposed to be initially, it's moving outside of the payment, let's say, purpose. It starts to be an investment asset. It starts to be more focused on storage of value. Its value is not backed by any government entity, rather it's being managed by the market forces. And it's not going to be a tool for any public policy. So those were, I think, the most important differences. And due to those differences, there are different legal limitations, for example. In many states, cryptocurrencies are currently being or already are somehow legally regulated. In the European Union, there are multiple projects being developed in terms of markets in crypto assets, in terms of creating an infrastructure on how the crypto assets are going to be exchanged, stored, paid, deposited, or exchanged to fiat currency. In terms of CBDCs, there are limitations in terms of constitutional law, because not every state allows for the issue of fiat currency in a digital form. So it would mean that some states would have to amend its constitution. So even though they are similar, because they are those two solutions are a way of getting into the digital age of payments and finance, they are a little bit different. That is why probably going forward, as crypto assets find their own place in the markets and as CBDCs start to focusing more in the narrow way into the payments area and into boosting the monetary policy and financial inclusion, they would probably both a little bit divide and conquer the market. But it seems that they would serve a little bit different purposes, be aimed at different audiences, let's say it that way. They would be based on different technological and IT solutions, or they would just be absolutely different, because CBDCs would be a mean for payment for small things, and crypto assets would help being either a wider option for payment, cross-border payments, providing a greater anonymity, or just an investment. So I think that those are similar, but they would in the end serve different purposes. But it's a very interesting thing to see how that all develops and into which direction that would go.
Thank you, Monika, for these insights. Maybe a question to you, Tara. We were talking about regulation efforts. It's true that now regulators are concerned about mitigating some risks with cryptocurrencies, notably in terms of market integrity and consumer protection. Overall, how do you assess current efforts to regulate crypto assets? Do you think there is a risk that this regulation could stifle innovation?
I think there's always a risk that regulation, however necessary, can stifle innovation. It's a delicate balance across all industries and all sectors. So, if we think about cash now, fiat currency, it will probably be outlawed because it wouldn't meet our current AML regulation. So whenever we have a new innovation that comes into the space, we do need to look at how we can safely deploy it and maximize the benefits, whilst also, as you say, not leaving ourselves exposed to market integrity and consumer protection risks. As Monika's touched on, though, there is a patchwork of regulation across the world. So it's certainly not unregulated, but there's lots of different approaches. If we take countries like Nepal, Bolivia, Algeria, and Ecuador, they have outright banned crypto. They've been incredibly hostile to cryptocurrency use. In countries like Nigeria, there's been confusion when it was prohibited for financial institutions, and then they had to clarify that maybe they weren't quite banning it for retail investors. And then in places like India, we've seen a kind of flip-flopping across whether they want to take a slightly warmer welcome to crypto or completely outlaw it. So there is definitely a mixed approach across the world. Some countries looking to lock out citizens from using crypto, which obviously means that they don't receive any of the benefits, but then they also are potentially protected from some of the disadvantages. However, not always, because crypto is borderless, it's permissionless. And so a state could regulate and say, we do not want our citizens using cryptocurrencies, but they can't, at the end of the day, completely prohibit it. If we look at other countries and their approaches, South Korea is a good example where they've taken a very negative stance towards privacy coins, but they've got really robust protections in place around digital assets generally. So they've taken quite a measured approach. The US, as expected, takes generally a state-by-state approach to things. So we have areas like New York, Wyoming. I think Colorado and Ohio and California are also becoming much more crypto-friendly. And then in the UK, we've got a kind of patchwork of regulation here as well, but starting to build in traditional AML and financial compliance with the digital asset space. So there's a lot going on in this space to try and protect investors or protect people using cryptocurrencies without, as we say, stifling innovation. I think one really interesting metric, which Elliptic, the company I work for, came out with this week, was that there's $2.5 billion in fines levied towards crypto firms since its inception in 2009. So it's certainly safe to say that regulators are taking an active role in trying to protect consumers. The vast majority of that was towards unregulated, what we call initial coin offerings, ICOs. And in that space, we have seen a lot of scams, unfortunately. So it's fantastic to see that from a consumer protection angle, the regulators are enforcing. I do think, though, it's important to balance that very large number with the fact that in the traditional banking sector, in the same time, we've had $231 billion in worth of fines. So there's been a lot of research in the cryptocurrency space by many blockchain analytics firms like Elliptic, which actually pinpoints illicit activity in crypto around about 1% of total transaction volume. So we do need to make sure that whatever regulation we're putting in place is proportional. We need to make sure that we're not just copy and pasting traditional financial regulation, which was created in an era where we didn't have digital money, we didn't have the same technology that we have today. So I think that's really important when we're talking about ensuring we can protect consumers whilst also not stifling innovation. Really making sure that the regulation we put in place is proportional and is very specific to the risks that we're trying to mitigate. And in crypto, that's certainly not the same risks in the traditional markets. So it does mean that our regulators need to have really good technical understanding of what DLT and blockchain technology is, what it can and certainly what it can't do, and where those risks lie. I do think we've seen examples, certainly in the US at the end of last year, when we had the proposed, the midnight rulemaking around unhosted wallets. There were big questions from the industry over whether this was proportional, whether it was actually targeting a way to stop financial crime, unhosted wallets, which means where someone holds their own private key rather than custodying it with a firm, whether that was actually where the crypto crime was taking place. And we do know that the vast bulk of activity happens with exchanges. So whether someone is buying or selling crypto for fiat money. So I think it is really important that to try and protect innovation in the space, we really do double down on where that crime is taking place, focus our activities on there, and then also try and support the innovation in the space more broadly, because we've got decentralized finance, non-fungible tokens, all of these really creative ideas happening. And so we need to make sure that instead of just seeing them as a money laundering risk, we try and think, okay, well, how are they a money laundering risk? What can we put in place to specifically protect that money laundering risk whilst fostering innovation? And of course, I would say, because I work for a blockchain analytics firm, but blockchain analytics is incredibly powerful in this. Blockchains are, for the most part, transparent, open systems where we can see the activity taking place. They're not black boxes like the banking system. They're not completely anonymous like cash can be. And so I think we can really leverage the power of blockchain technology to try and fight some of these money laundering and compliance risks, rather than just trying, as I said, either copying and pasting traditional laws or assuming all the activity is illicit and therefore creating rules which may be disproportional to the actual risk.
Thank you very much for this answer. So regulation should be proportional and should not kill innovation. And thank you for the overview of national approaches. It was very nice. Monika, widely expressed concern about CBDC. It's that central bank digital currencies may actually crowd out commercial bank deposits and lead to disintermediation of the banking system. Do you think this is a real threat of CBDCs, or is it an exaggerated fear? And is there any particular design of CBDCs that could reduce this risk?
So as mentioned at the beginning, those are the questions that I would like to hear the answers to, not to give them, because while preparing for this, I did quite some research on the internet, and since I started to get interested into this topic, that was always one of the greatest concerns. There are like two concerns. First was always in terms of privacy, how would the privacy be managed by the CBDCs? And the second one is how would be the impact on all types of financial institutions or financial sector intermediaries and all wide types of institutions like banks, e-money institutions, payment institutions, some kind of lending agencies, and so on and so on. So the research that I did a little bit highlighted that nobody really knows, because there were some academic papers that highlighted that, for example, referring to historic bank runs, for example, in France in 1930-31, the introduction of a safer way of storing money that is government-backed did, in smaller to a smaller or greater extent, to a bank run. So the risk is not only considered to be a theoretical one, and on the other hand, there still are some academic papers that consider this to be an exaggeration, and that they consider this to not be fully grounded in any observations or any potential analytical models. But maybe not necessarily everyone understands why is this such an important matter, because it starts from understanding that everyone wants at some point in time to get a credit from a bank, and preferably at the lowest interest rate possible, because we want to pay as little back to the bank as possible. But the banks are giving the credits from the deposits they collect previously. And due to many experiences we had in the banking sector, there are multiple ratios that banks need to meet in terms of how much money they have from deposits and how much money they give away in terms of money creation and giving credits to the wider public. We've got this liquidity coverage ratio. We need to make sure, or banks need to make sure, that they've got proper maturity that's matching deposits and credits, and so on. If in any shape or form central bank would step into this money creation process with some kind of a smaller or greater digital currency deposits that would be either stored at the CBD at the central bank, or would be stored at the private banks' accounts, it needs to be fully understood and analyzed how, if, and even if, those funds could be used for the credit action by the private banks. So, for example, Bank for International Settlements and the European central banks have understand that there is an issue that people, for example, might be holding more money in this central bank digital currency that is backed by central bank. It's not a private form of money, it's a public money, contrary to the funds that we hold at private banks accounts that are the liability of a private institution. So whenever something goes wrong with the bank, or a bank goes bankrupt, or it enters resolution, we might lose some funds after the guaranteed amount, after the deposit guarantee amount. So there might be a shift into the government-backed funds in form of the CBDC, which might impact how much private banks can actually move to the or lend out as a form of a credit. So the ECB and the Bank for International Settlements see this as a potential risk. They do not fully measure it or consider that this is a significant risk or this might impact the financial sector at this extent, but they acknowledge its existence. That is why there are some solutions that are at this stage suggested to mitigate it. One of the solutions suggested, I think it was 2 days ago actually, when the Bank for International Settlements suggested those two-tier system that would include financial institutions as intermediaries into the CBDC world, would be offering a higher interest on bank deposits or offering a negative or zero interest on CBDCs. But again, this is very maybe easy to suggest. However, it needs to be always considered. Would that not cause the difference in the par value between the cash and between the CBDCs? That it's like one of the ground rules of the CBDCs that they always have to be at par with the fiat currency that is in cash circulating in this particular state on this market. The second solution would be, for example, imposing limits. So you can hold on a bank account or your account with the central bank only 500 digital euros. Anything above that would be automatically swept. Sorry, there would be an automatic sweep that any excess amount would be moved to your private bank normal bank deposit account. So that's another solution that was suggested. But again, in reality, would that actually work? That probably would have to be seen, or more details would have to be worked out and understood if that in practice would actually meet the purpose of the CBDC. And the last thing is that the situation of financial institutions in this new environment and this new ecosystem would have to be understood from various angles, because those intermediary or tier systems also suggest that the banks should be responsible for the AML KYC and the client onboarding, because the central banks do not have people, they do not have skill, they do not have man hours to sit with everyone to do this onboarding process, to verify the passport, to verify all the documents. So this gives banks additional obligations, additional costs, operational costs, IT costs that they would have to undergo. On the other hand, the CBDCs take a little bit from the bank's business, or at least endanger the bank's business. So that would have to be, again, very carefully thought through. It's an interesting thing to see what are the solutions suggested by various institutions, but there is no agreement, I think, in the newspapers, in the market, in the central banks themselves, if there would be an impact on bank deposits, and what precautions could be made to make sure that those risks are mitigated. So we are heading into a very interesting area here, I think.
Thank you. Yeah, it's true. It's a complicated issue with this question about disintermediation with CBDCs, and your answer was very interesting. Also, from what I read, also they sometimes make a distinction between times of crisis and normal times, and it's true that those fears are about disintermediation are also related to, more related to times of crisis, where people would maybe more eager to switch their money from the bank account to CBDC's account. But I guess there's no definitive answer about it. So it's still the debate is going on, I guess. So maybe one last question to you both. As we all know, privacy has become a very important question. Also with digital payment systems. So we were talking about CBDCs, about cryptocurrencies, or even stable coins. From your point of view, which one of these payment system would be best suited to give some guarantee to consumer privacy? Because regulators, I think they are a bit in a dilemma. On one hand, they want to guarantee consumer privacy. On the other hand, they would like to have also the possibility to track payments in case of fraud or whatever. So it's not an easy task. What is your assessment of this question? So I don't know who's starting. Maybe Tara.
Yeah, I have to take this one first. So I think the first thing that's really important to remember, and I'm sure we all certainly on the call know this, but just because someone needs privacy or anonymity certainly doesn't mean that they're a criminal or doing anything untoward. There's so many people around the world who live in authoritarian governments, countries where their political beliefs might not be respected, where they might not have religious autonomy, or just where kind of fiscal and corruption, management is basically in the political system. So I do think it's really important that when we're talking about CBDCs, cryptocurrencies, this new world of digital finance, that privacy is really important and can be maintained. So I think for me, I see having a choice of all these different assets being really important. So cryptocurrencies, which are decentralized on public blockchains, I think are really important to get all of their benefits, and the ability to choose a more privacy enhancing cryptocurrency or a completely anonymous asset out there, like for instance, Monero. I think it's important that people have that choice. I think stable coins, if they start to be used more for traditional kind of transacting, it will be very important that there is a stable coin out there with some privacy preserving properties. And likewise in CBDCs, if that's going to become the main use of assets, then again, I think that's really important. What worries me, I think, is seeing countries, for instance, like China, that don't have the best records on user privacy, would DCEP their digital currency, and the concept of, I think they call it controlled anonymity, which means obviously you can't see the activity of other citizens, but we can see everything as the government. I think that's a really dangerous benchmark to put in place, because you're only ever one election away from having a government that you might fundamentally disagree with. And so I think if we're going to create a future of digital currencies in whatever form, we need to make sure that privacy is baked in. And that, of course, doesn't mean that criminals can just run wild. We have fiat on and off ramps, which are always, I think, going to be important. I don't personally subscribe to the idea that we're going to be 100% cashless in the future, or at least not to a very, very long time. So I think having pinch points where we can make sure that if someone is using a anonymous asset, we have other protections around. So I don't think that is impossible at all. But I also do think that trying to argue against privacy or anonymity on the grounds of trying to stop criminal behavior isn't an accurate argument. We've had money being around for like 30,000 years since the concept of money kind of was born. And in that time, we've always had financial crime to some or greater degree. And so trying to find a zero crime world is impossible. Instead, we should be trying to think about how do we have privacy, which is important for many licit reasons. How do we maintain that with this new technology? And how do we also use this new technology to try and strengthen our protections around financial crime? I do think cryptocurrencies are certainly transparent. Public ledgers provide a great opportunity to do that. And then it's all about working with, I guess Monika said, making sure that as governments and financial regulators are coming up with these new ideas, and it is very much still forming around how we can build these things, that concepts of privacy are really heart and center, because it's absolutely critical for financial inclusion and just well-ordered society.
Thank you, Tara. Would you like to add anything, Monika?
Yes, so there's not much to add because you have raised a very valid points, but maybe a couple of additions still. First of all, when the ECB issued its consultation paper last year and the response deadline was, I think, April this year, privacy was the very most important item that was raised by respondents to the consultation paper. So those were the responses from citizens, from banks, from financial institutions, not for criminals. So as you mentioned, everyone is rather concerned by the privacy, not necessarily due to some shady reasons. And I absolutely agree with that. And I think that all the central banks also see this as a very important point in the designing of the CBDCs. That is why it is still yet to be decided what would be the form of the protection of privacy. So first, it might be that the ECB would only see the transaction and the transaction amount, but would not be able to see the recipient and the sender of the transaction. That was one suggested point. Not really sure how that would work if both parties would have to have some kind of a soft token or hard token or app that would identify where the money goes to and from. But the second point is that not necessarily CBDCs are yet to be set on DLT. So it might just be a central bank's ledger or any kind of an accounting system that would be processing what already central banks have access to, because they are central banks, so they are government entities. In one way or another, they can sooner or later get access to the information that every citizen has, that the state has on every citizen. So it wouldn't necessarily be anything new that the central banks would not have to work very hard to get at this current stage. Also, the second point maybe with that would be that it might give some people some comfort that in those intermediary two-tier system, the private institutions would be responsible from the KYC and onboarding process, and they would be like a gatekeeper between the citizens or the users of the central bank digital currency and the government. That is why they would be keeping the information as a private entities like they actually do now, because whenever someone wants to open a bank account, they have to share some information with the credit institution, with the private bank. So they might be keeping this information and not necessarily sharing all the sensitive information with the central bank. However, currently, as maybe some of you know, there are requirements that private banks, private institutions on a daily basis need to submit to the supervisory authorities a list of names and the list of IBAN numbers of all the accounts that they are holding with retail and corporate customers. So central banks, if they are also supervisory authorities, they have already access to those information. So it's not like the introduction of CBDCs would kind of introduce an enormous change, an enormous invasion on privacy of people using already the some kind of some form of digital payments, or generally not only using cash. Those data sharing processes already exist, and in some shape or form private information and data is already being circulated between the central bank and private entities. But what is quite interesting is that, and I do not know answer to this, if central banks use the DLT to operate the central bank digital currency, I wonder what would be, and I don't know the answer to this one, I'm not a GDPR lawyer, how would be the, or maybe you, Sarah, know this, the execution of the right to be forgotten, and how can you make sure that your data gets wiped out from the blockchain? Because I understand that's the point of DLT, that no data ever gets deleted without the agreement of 51% or something like that. So that maybe is also one of the points that's being raised around this privacy area.
That's an excellent question, which I have no answer to. So I don't know if you have any other insights on that, Zara. But me, I never thought about that point. It's a good question, because it's true that on DLT normally you cannot delete data. So you're right to be forgotten.
Yeah, definitely.
To respect.
So I remember when I think it was GDPR kind of being introduced, or there was like a significant, maybe it was the regulation actually coming into force. There was discussion across the blockchain industry about what does this mean for us? Because yeah, Monika, you raised such a valid point, which is once something is on a blockchain, you can't delete it. So if you're putting information on there, then it's on there forever. If you're putting it on in a hashed format, so you're basically having the information stored somewhere else and the link to it is on the blockchain, and the link is on there forever, even if you later remove the activity. So it's certainly a question that will need to be explored from a GDPR point of view.
Interesting. A question to be followed maybe for our next conversation. But thank you very much to both of you for your insights and the very interesting conversation. It was very instructive, and I was glad to take part to this conversation.